So as stocks continue to sell off, investors are keeping an unusual option market volume. They're looking at option market volumes, looking for signals that we may be approaching correction territory. Randy, you've voiced concerns recently about the unusual option market volumes. And how do we as investors take what you've noticed, the pattern, and use it to our advantage?
Yeah, so what I noticed, which is highly, highly unusual, is we were hitting record option volume levels prior to the market pullback. That's extremely unusual. Big volumes on days like today or yesterday are very common. When the market goes into a correction or a pullback, it's real common to see volumes spike because people, first, they sell out of their profits as quickly as they can before they lose them. Secondly, they start putting on hedges to try to protect from further downside. And then third, the last thing they do is they step in and start bargain hunting, which we see that happening now. So all three of those things tend to drive volumes way high when you have a pullback. But we were at record high level volumes for the last couple of months prior to this, which is just unheard of. So what it told me was I started digging further into it and looking at things like the put-call ratios and the volumes on equity options, which has a very high retail component. And there were a lot of very troubling signs. So I'd been putting out warnings for the last few weeks on this stuff, was that people were buying calls like crazy on the equity side, in the retail part of the market specifically, and leaving the upside open, as opposed to a lot of spread activity, which we typically see. So what that means was that people were not only bullish, they were bullish, and they wanted to leave the upside completely open. That's just really to the point of irrational bullishness, frankly. And those are not things that cause pullbacks like we've had, but they make people a lot more vulnerable to getting hurt when we do get one that's caused by a black swan event like this virus.
So as you say, it's not unusual then when the selling happens to see the spikes in volume. So what are you seeing now, especially, now we've got a bounce back, at least for the moment. We'll see if it's as short-lived as yesterday's. And can that options activity tell us anything about a more sustained move in markets, or is it more useful as a short-term tool?
Well, definitely volume in options markets, as well as put-call ratios based on volume, which are driven by that, are very, very short-term, and they're very reactive to the market. So, for example, we went from like a 45 put-call ratio, which means people were only buying or trading 45 puts for every 100 calls, to immediately like a 90 or a 95 the day the market starts going down, like yesterday. So those kinds of things are very, very short-term and very reactive. If you want to look at a longer-term thing, you have to look at put-call ratios that are based on open interest, which is total number of outstanding contracts. So far, we really haven't seen a huge shift there just yet. So long-term, people are still pretty much where they were. And
just a little translation for folks who are not as familiar with put and call ratios, right? A put is effectively a contract to sell a stock in the future. A call is to buy one. So puts are bearish, calls are bullish, in the most simple